Thanks for tuning into Talking Point. I'm your host, Niraj Shah. The case for a chat today, on the day after the Fed has not sounded as sanguine as the markets believed it would, or at least the minutes didn't, is this, the Fed stance and the impact on flows, if so, global flows that is. Consumption, whether there will be some bit of a growth pickup that we will see, and is that the defensive that the markets may want to bet on? And the third, and a very important one, is the convergence of the capex in the consumption cycle. Will we see that, or will capex far outstrip consumption for calendar year 24 and beyond? Our guest today is Ganeshram Jayaraman of Avendus Spark. Ganesh, great having you. Thanks so much for taking the time out and being with us. And at the outset, to you and team and family, wishing you a very happy 2024.
Thanks, Niraj. Good speaking to you. And Happy New Year to you too.
Thank you so much. Will it be a Happy New Year though, Ganeshram?
We've turned a little more cautious than we were last year. I think clearly the market performance last year, that's one reason. But the bigger reason, I think, is there is a little too much extrapolation happening of how last year looked and how we seem to be extrapolating the macro outlook and the earnings expectations into FY25. What we did was, we cover about 250 stocks in our coverage. We did a kind of a deep dive, slice and dice the earnings expectations for FY25 and maybe even beyond that. And our conclusion is, in the last 4-5 years, maybe more like 3 years, the earnings growth was led by controllables within a company: market share, pricing, raw material prices, or operating leverage. It also re-rating potentials were available. Now, at the margin, when I try to assess where can the earnings expectations get built, it is coming from industry outlook, which comes from macro outlook. And when we look at that framework, we think we shouldn't be extrapolating calendar 23's more benign, more Goldilocks kind of macro outlook into next year. And that's where I'm a little more skeptic on earnings expectations getting into FY25. FY24 is not such a big problem. I think we have had earnings tailwinds, and I think that kind of will sustain for a while. It is FY25 and beyond that I'm not yet fully confident. So what we are telling investors is we need to have a barbell. There are some sectors where you're going to see pretty strong tailwinds. There are some headwinds which will come. So we need to be positioned accordingly. And that's what we are telling investors. Don't extrapolate calendar 23 into 24. That's the message.
That's a big message. I wonder, and I'm guessing, Ganeshram, that as more evidence emerges, some of those thoughts may change as well, for the better or for the worse. But as things stand, what are the numbers on the earnings front that you are penciling in? I don't know if you put out in your note, but let's say I heard you say FY24 is not a challenge. So what is the number for FY24, and how low is the number for FY25 in terms of growth?
So FY24 is an abnormal year. We have never seen a year like this where top line growth will be maybe 5% for Nifty or BSE 200, BSE 500, whichever universe you take, right? It's 5%, but bottom line growth is in excess of 20%. Okay, and this was, of course, on the back of a weaker year the previous year when commodity prices went up and margins kind of corrected in the previous year, this is FY23, calendar 22. On that base, we have recovered a fair bit on margins front. About 75% of our coverage universe, gross margins are at or close to all-time high. Okay, EBITDA margins are at or close to high for almost 65 to 68% of the companies. Sustainability of this needs to be analyzed, and that's what we have done. And we think for that to sustain, you need volume growth to pick up, and volume growth recovery needs strong macro. And there are questionable assumptions on the macro which make us believe that there will be earnings downgrades in fiscal 25 vis-a-vis the expectations today. Expectations are running at about mid to late teens in fiscal 25. We think there is scope for downgrades on that in multiple sectors. I'm not saying all sectors, in multiple sectors.
Okay. And before I ask you about those factors, Ganesh, I'm just wondering, does global macro also play a part in this? Because, for example, the overarching belief was that the Fed rate cuts would come into play. Now, post the Fed minutes yesterday, the doubt about when the timing would be is probably a bit more enhanced. I'm not talking about hikes really, but just that. And what the Houthi rebels have done and altered the shipping courses might mean that for exporting companies or for importing companies, the cost for Q4 might also go up. So does global macro play a part in these changed assumptions?
Definitely, it always does. Lesser extent for India than for other countries, but definitely it does have an impact. And one of the points that we have had for the last many years is we are generally not too worried on rate hikes in the initial period. Likewise, rate cuts in the initial period tend to get us little wary. Okay, why? Because see, what is rate hike or what is rate cut? Why does a central bank hike rates? Because he wants to cool the economy. He thinks pricing power is little too much. He thinks inflation is sticky. Inflation stickiness means pricing power, right? And equity, we like it. Okay. Whereas when central bank starts cutting rates, we will ask, why is he cutting rates? Okay. Deflation is not good for equities. Okay, pricing power is not good. So when central banks cut rates, it is on the back of either existing weaker demand or likely weaker demand, and that's what gets us a little more skeptic. So rate cuts generally is not something that we will take cognizance of positively. Initial periods, even eventually it will come to help demand recover, but there is a long time. The cycles take 2 to 3 years. Rate hikes to rate cuts. This is a 3-year cycle. We need to understand these cycles a little deeper.
Got it. Okay. You want to talk about that right now, or do you want to talk about the point that you just mentioned, Ganeshram, which is the factors that might change the assumptions around margins and earnings?
Yeah, the key thing is consumption. Okay, we have been wary of consumption in the last 3 quarters, maybe 4 quarters in a row now. Mass consumption is slowing down, and we are not seeing some of the lead indicators improve. Lead indicators such as jobs, IT sector jobs, or wage hikes, or savings bank balances growth in them. We are a little more cautious on that. On one hand, we have seen that. On the other hand, I'm seeing unsecured personal loans continue its 25% growth journey so far. And the central bank has now stepped in and said, watch out for a bit there and step back. He's been telling banks and NBFCs to turn more watchful there. We think banks and NBFCs will moderate their expectations on unsecured personal loans next year. Now, mind you, this has now become a 16 to 17 lakh crore loan book size across banks and NBFCs, and that's kind of doubled over the last 3 years. So, will it when that moderates? I'm looking at the second order, third order effect of that on consumption. Okay. Household balance sheets. I'm not looking at pan India. I'm not too worried about the top 5 crore households. I'm not even worried about the bottom 5 crore households, because there will always be some welfare measures there, or maybe they've not been aggressively lent into. It is that in between basket where I'm a little more watchful now. I think if unsecured personal loans are less available, the impact of that on consumption, possibly even into retail flows into the market, not just mutual fund flows. Maybe that's more SIP, that's more sticky, but more into derivatives or the non-SIP flows. I'll be a little wary of extrapolating some of these which have happened this year. And this year saw the 2,000 rupee note ban, okay, which brought 3.5 lakh crores into the banking system as deposit mobilization. And that led to, and top of it, commodity prices were weak. Imported inflation was benign as a result. Not just inflation, we had a benefit of that on the current account. Oil prices were benign. You saw, the benefit of all of this coming in as a BOP surplus of $30 billion in the first half. And that means 2.5 lakh crores of rupee equivalent money into the banks. From somebody outside India, it came into India. into somebody's pocket in India, right? That's 3.5 lakh crores of note ban, 2.5 lakh crores of this, 6 lakh crores of in some form incremental deposits which have funded the credit growth, and that's helped the economy broadly do well. In spite of it, top line growth has just been 5%. Keep that in mind. And secondly, as I said, earnings growth were pretty good. That led to tax collections, and that which meant government could push capex quite aggressively for the third year in a row. In this year again, that led to cement demand at double digit or volume growth, or if you saw the railways or defense or some of these fiscal led impulse into the economy do well. But when I post FY24, when I'm looking at FY25 and beyond, I think we need to be a little more moderated on consumption, number one. Number two being the fiscal spend led impulse into the economy that should start moderating. And number three, exports, which have remained weak in the last, maybe 18 months now, maybe 12 to 18 months now. And I'm not sure I can start penciling in growth into exports next year as well, given how the world is, demand is looking. So, which means three buckets of moderating kind of growth. Whereas the one segment which I'm very positive on, and I still remain, which has been my view for now, 2.5 years now, and we hold on to it, is the whole capex cycle. And we continue to believe that corporate capex cycle will pick up next year. Corporate balance sheets, in fact, even banks, as they step off the pedal on retail credit, will actually step on the pedal on corporate credit. And property related pickup will also be seen. Okay. Unsold inventory in the top 15, 20 cities is almost at a 12-year low. So new launches, which have been a little slack so far, unsold inventories got sold, mind you, but new launches drives demand, okay, for many of the building materials or others. So they should pick up. So we need to shift our portfolio stance away from IT or exporters, or to a lesser extent even in consumption, more into B2B industrials, the capex cycle, especially private capex cycle related names, property cycle related. That's where incrementally we are advising investors to move into.
Okay, so viewers, we need to slip into a break, but the two takeaways thus far, that if all the stimulus that has happened thus far only drove a 5% earnings growth, and if the bottom line growth was led by controllables within the purview of a company, what happens when both of these factors change a bit in FY25 and 26? So key question to ponder over. Multiple answers to that, maybe. Think about it. And of course, we'll talk to Ganeshram about the barbell approach that he spoke about, considering the state of the markets on the other side of this very quick break. Stay tuned. Back with Talking Point right here on NDTV Profit, in conversation with Ganeshram Jayaraman of Avendus Spark. And he was talking about the necessity to approach the markets with a barbell approach. They're telling their clients to do that. Now, Ganeshram, let's talk about the barbell approach. Let's talk about what to avoid first. You've given us a hint of what you like, and I'll talk about that. But what is it that you are avoiding, and why so?
The segments that we are wary of, as I said, is IT to an extent, exports in general, but IT specifically. We see some downgrades, and I think the street's expectations and earnings are a little too aggressive. So I'll see for that. But more specifically, companies or segments, not just companies, but also where there is the benefit of this unsecured loans, which were quite a significant driver of consumption, right? When that trails off, when that, I won't say dries up, but it will trickle off, then somewhere the rub off of that on some other the second order derived effect of that will be seen. We think that will be more in the consumption category. So segments where the premiumization was a driver, including staples. Okay, we'll be discretionary consumption. We'll be a little more watchful on how the consumer will react, or where will his spending pie change when that happens. Those were the segments where we are more cautious on. And also the third is global cyclicals, metals, oil and gas, chemicals. The global cyclicals will still be more wary of. But when I meant barbell, what I meant is not from a sectoral standpoint, but more from a character standpoint, which is quality. There are quality managements in every sector. So, and keep in mind, in the last 3 years, the cyclicals have done well. So the quality managements, quality companies, good governance, they have actually underperformed. So what I'm telling is, one side of the barbell, we need to go back to quality, okay, and keep a quality measure by track record of cross cycles, not just up cycles. So clearly, quality is one end of the barbell. Okay, this comes across sectors, but clearly quality is one side of the stock picking framework that we are focusing more towards. Second, other end of the barbell is cyclicals, but where? Because as I said, private capex, private sector, corporate capex, property related capex, I'm still positive, very much positive on. So one other side is that side, private, not as much government capex focused, which I'm not saying will fall off, but I think it will plateau, and which means multiples, not earnings, are at some risk of getting moderated. Whereas when you look at government capex, the character is more when they buy land, it's more spend on cement-led, roads, infrastructure spend. But when you look at corporate capex, it's a different character, largely brownfield led. So it's not much land. It's more of equipments, capital goods, engineering companies, which will get demand there. So clearly shift within industrials, shift from government spend to more private spend, and the nature of companies are different. That's the shift. So within cyclicals, where there are likely to be growth tailwinds, are in private capex names. So clearly that's one shift. The other side of the barbell, in the second side, what we are also looking for are market share gaining companies in other sectors. It could be in two-wheelers, it could be in aviation, it could be in diagnostics. Clearly, there is a market share gaining companies which we will have, even durables, actually, air conditioning, for example. So clearly, market share gaining companies or companies which have earnings tailwinds, we will continue to, even though they are cyclicals, we will have that in other side of the basket of this whole barbell. Where we have also increased weights in our model portfolio are two other segments. One is pharma. I think after about, we've been doing it for now 3 months now, pretty much since September, where we saw that the pricing environment for US generics has started getting better, and we have started increasing weights in the pharma healthcare space. We continue to see that segment having a pretty good margin of safety. The undemanding valuations still in that segment, so gives us some more confidence to be there. The other segment where we have increased weights is cash. Okay, we have actually never in the past recommended cash, but we think, given the environment, given how we think the valuations have trended, especially in the mid and small cap space where some bit of euphoria has set in, we have kind of increased our levels of cash in the recommended set of stocks, or I can say even in the recommended portfolio. Bias of cash has gone up, and we've not dropped weights on large caps. Actually, large caps are okay. I'm not too concerned about it. Is more mid and small where we have recommended this change.
Minutes left on the show, so I'm going to ask 3 questions to Ganeshram in a bit of a rapid fire format on all the things that he said. First up, I heard you say, Ganeshram, that the new real estate cycle, new launches, unsold inventory, and therefore the building material demand comes back with a bang or goes higher. Now, what sub-segments within this real estate thing would you play? Would it be real estate companies themselves? Would you necessarily play building materials, or would you play something else?
All there are various segments. For sure, developers, financiers of that for sure. Could be banks, some NBFCs, select few. It will be paints to some extent, but we are not too positive on paints because the industry structure there is changing, more competition. Durables, invariably when houses get sold and they get completed and more sales happen, durables do benefit. So we'll watch out there. Tiles segments, sanitary or bathroom fittings, or it could find ply. Could be a sector we are still not too convinced on the ply segment yet. The companies are well managed companies, but I think there will be a lot of supply coming in the next 12 months. I'll wait for some supply variables getting priced in. It might impact margins a bit in the short term, but I'll wait for that before I look at pipes. Plywood pipes for sure are a segment that we need to keep an eye out. So there are multiple segments, sub-segments within the building materials, or not just building materials. It could be derived proxies of property, which could be quite positive.
Okay, but remember, viewers, he said that stick to quality. So that's the overarching theme within the companies as well. 2 more questions very quickly. I heard you say that market share gaining companies in various sectors. I'm picking up aviation here. I presume by aviation, you just don't mean airlines, maybe airports, maybe airlines, maybe suppliers as well. What within this? Because if you look at airports or airlines, there are just 3 companies to play.
I know what you're saying. It's a little easy. I definitely do mean airlines.
You mean airlines as well? Okay.
Yeah, of course. But my compliance restrictions will restrict me from talking about stocks on air. But for sure airlines, and it's not too difficult to guess the name. But for sure airlines.
What about airports, Ganeshram? I mean, there is one listed and one partly listed company. Do you like airports?
We need to do some more work on that. Not completely convinced on that yet, but maybe 3 months later.
Okay, great. And my final question, Ganeshram, is on pharmaceuticals. I heard you say that you've turned constructive. Is it only the US generics, or do you like APIs, diagnostics, hospitals? What do you like and why?
US generics pecking order comes first. I think the pricing environment there is getting better. The demand supply dynamics, product launches, and also, as I said, undemanding valuations in many segments there make us think that pricing US generics within the segment of within pharma as a whole, it looks pretty most attractive there. Other segments are not exciting. There is not much non-linearity left, and valuations are on the higher side, especially on APIs or even the hospital side of things, a little on the higher side. And new capex beds addition will start coming in there. Nothing will impact the top line or the margin front for now. But generally, what we have seen is when beds capacity start coming in, negative operating leverage starts, and ROC starts moderating, and that tends to put some bit of pressure on valuation multiples. So we will actually maybe watch that how much beds get added in the hospital space, and accordingly we'll take a fresh look later on. But as of now, hospitals, though it offers a fair bit of you can say top line earnings kind of stability, we are not recommending them.
Ganeshram, such a pleasure talking to you. Thank you so much for taking the time out and being with us on Talking Point today.
Good speaking to you as always, Niraj.
Thank you. And viewers, we didn't discuss any stocks, but if you took some derivation of what Ganeshram was trying to say, please do consult somebody before trying to act upon it. Nothing out here is a recommendation. Thanks so much for tuning into Talking Point today.